Zee Entertainment's profit fell 38% in the December quarter. A fall in advertising revenue can be attributed for the earnings hit, while subscription revenue remains buoyant. We caught up with the Zee CFO Rohit Gupta to understand the pulls and pressures on the business. Listen in.
Zee continues to perform well, and we have seen buoyancy in our subscription revenue. Our domestic subscription revenue has actually grown by 21.7% during the quarter. And for the 9-month period, our domestic subscription has grown by about 31%. This is obviously on the back of the new tariff order, where Zee has come out, very strong, and that has been the result of our strong customer connect and brand pull of our channels. We have seen that the growth has been impacted by the slowness in the consumer sectors for our ad revenue. And however, we see that this quarter and this year has been an exception. If you see our historical trend, you will see that in the last 5 years, our ad revenue has seen a CAGR of about 12%, and 16% actually, and top line of 12%. And we have doubled our EBITDA during the period. So I would say that, we are seeing, we will see bounce back of advertising revenue in the next coming quarters.
So are you complying with the new tariff order, or will you wait for the court order? Under the new tariff order, which comes into effect from March 1, so do you see any kind of challenges, coming in terms of your subscription revenue, or for broadcasters like you going into FY21?
Well, the new tariff order 1.0 was implemented last year, and we were among the first ones to announce our price points. We had also seen, that industry has been in the process of stabilizing, and the consumers have finally, adopted the new tariff order. But however, in less than 1 year, we have seen there's a change in the new tariff in the NTO. And 2.0 was announced, and as you're aware that the IBF has collectively for all broadcasters gone to the court against that. And I'd like to mention here that our managing director, Mr. Puneet Goenka, has already expressed his views on that matter, and so we'll leave it at that.
So will there be any kind of increased pricing pressure under the new tariff order, and how do you intend to address this?
So, like I said, we'll wait for the court's decision, which may come in, by the end of this quarter.
And so there was a delay in the receivables from Dish TV and City in the previous quarters. Has this delay been? Has this company been able to recover any dues from here? And if so, to what extent? And do you expect the receivables to come down in fourth quarter, as the management had stated earlier?
We have been seeing some delays from the receivables, both from Dish and City. And, there was a payment plan which has been given. I'm happy to say that City has complied with the payment plan. However, from Dish, there has been a certain delay. And, based on that, we have done a very detailed assessment of our collectibles from both Dish and City. I'm happy to see that, we feel that our receivables are good and collectible. However, there may be certain delays, and but over a period of 12 to 24 months, we expect that, our receivables will be in line with the overall market. However, just to be prudent, the company has taken a charge of 376 million because of the delay that it expects in collecting these receivables, and this is as per the accounting standard 109. We have also disclosed that in our financials accordingly.
Well, right, you did mention about it that there was an expected credit loss of almost 37.64 crores recorded during the quarter. Against the receivables, I think that was worth almost 750.28 crore rupees. So what is the status of the balance receivables? Do you expect to recover these in the near future?
Of course, we expect these receivables are good. They are fully collectible, and however, we may experience delays. And we have done, like I said, we have done a detailed assessment of the same. So we expect that between 12 to 24 months, all these receivables will be collected by the company.
And so the auditor has given a modified opinion, on the related party payments adjusted by the parent against a 200 crore worth of fixed deposits. They said that they are unable to comment on the same on account of non-availability of relevant information. What's your take on this?
So as you're aware, in the last quarter, Scheduled Bank had appropriated a fixed deposit against some of the related party receivables. We had disclosed it appropriately, and in this quarter we have taken the legal opinion, and we have also taken our board approval to set off what was receivable from the bank against the what has been reimbursed to us by the related parties. However, there is certain documentation which is in process, and the auditor's opinion is based on that. Like I said, however, the company has the legal opinion, and it has been appropriately approved by the board of directors.
So by when do you expect this documentation process to be completed?
We expect that within this quarter, it will be completed.
And so last question is, what has been the impact of the huge content and programming expenses which are incurring, which has actually hit the EBITDA? Does the company expect these costs to go down, going forward into FY21 and FY22?
So we have been aggressively investing in our content cost, but I'm happy to state that we are ending the peak intensity of our investments. We have been focusing on our free cash flow. Our overall cash and cash equivalents have also improved from last quarter to 1767 crores this quarter. So there is a positive cash flow. We are now really focusing on our PAT to cash conversion ratio, and we hope that in the next fiscal there will be improvement in the cash. Our PAT to cash conversion ratio should be anywhere in excess of 50%.